90% of students fail in financial risk management subjects if they miss these questions. And if you're struggling to learn this problematic subject, this video is exactly for you. Forget reading hundreds of pages. I have brought the most important Unit 1 questions that every MBA finance student must prepare. And yes, there's a free PDF waiting for you. Stay till the end, because one missed question could cost you valuable exam marks. Let's get started. This is part 1 for Financial Risk Management playlist. Unit 1. Introduction to Risk Management 1. Define risk management. Explain its nature and scope. Risk management is the process of identifying, analyzing, evaluating, and controlling potential losses arising from uncertainties. Nature of risk. It is situational, time-based, results from uncertainty, is part of every business and depends on size of business. Scope covers risk identification, assessment, control, financing, monitoring, strategic integration, and compliance reporting. It helps businesses reduce losses, improve decision-making, and achieve long-term sustainability. Let's move ahead. 2. Discuss various risk identification tools and techniques. Risk identification tools include SWOT analysis, risk checklists, risk prompt lists, risk taxonomy, risk trigger questions, case studies, and risk-focused process analysis. Techniques include brainstorming, where teams suggest risks openly, Delphi technique for expert consensus, interviews for individual insights, and working groups for cross-functional identification. These tools ensure systematic and comprehensive identification of risks, forming the foundation for effective risk management. Next question. 3. Discuss different types of risk and risk management methods. Types of risk include business risk from poor strategy or competition, liquidity risk of inability to meet short-term obligations, foreign exchange risk from currency fluctuations, country risk from political instability, and other risks like operational, credit, and cyber risk. Management methods include risk avoidance, risk reduction, risk transfer through insurance or hedging, risk retention, hedging using derivatives, diversification, and contingency planning. Moving on. 4. Define capital market risk and product market risk. Explain its types. Capital market risk is the possibility of loss due to adverse price movements in financial instruments. Types include market risk, industry risk, regulatory risk, business risk, interest rate risk, liquidity risk, and product risk. Product market risk is loss from price fluctuations in specific products or contracts. Types include credit or default risk, basis risk, settlement risk, currency risk, foreign exchange risk, and commodity risk. Now the next one. 5. Discuss the risk management process. Risk management process has 4 steps. Identify all significant risks using SWOT analysis, checklists, and brainstorming. Evaluate risk exposure by measuring probability and impact using VAR and risk rating methods. Develop and select appropriate methods, choosing avoidance, reduction, transfer, or retention based on cost-benefit analysis. Implement and monitor the program by assigning responsibilities, training staff, and continuously reviewing risk levels. The process is continuous and cyclical. Now the next one. 6. Explain risk management approaches and methods. Risk management aims to control risk through 3 approaches. Risk control, which includes risk avoidance to eliminate risk activities, and loss control to reduce loss impact through safety systems. Risk financing, which includes retention using internal reserves, insurance for transferring risk, hedging using derivatives, and contractual risk transfers through outsourcing and indemnity clauses. Internal risk reduction through diversification across products and markets and investments in information for better forecasting. Now the next one. 7. What is risk reporting? Explain the risk reporting process. Risk reporting is communicating information about identified risks, their assessment and mitigation status to stakeholders to support decision-making. Process includes internal reporting through risk dashboards and compliance updates for management. Time period defining daily, weekly, or monthly reporting frequency based on risk type. external reporting to regulators like RBI and SEBI through Basel III and annual reports, independent risk oversight by audit or risk committee to verify accuracy and ensure governance. And that completes Unit 1 clearly. See you in next part.